Hello and welcome to this session in which we will discuss financial risks and how to mitigate the various financial risks. Now, what is a financial risk? Well, it refers to the possibility of losing money, capital, when you make an investment or you go into a business venture. Simply put, when you make an investment, when you buy bonds, stocks, start your own business, there's always the risk of losing money. There are several types of financial risk that could affect your investment as an individual, as a company, as a government, or as any other entity. We're going to list them: interest rate risk, credit risk or default risk, liquidity risk, currency risk, market risk. Are these the only risks that you could face when you start a business or invest money? Absolutely not. The amount of risks are endless, such as country risks, operational risks, so on and so forth. We don't care about those risks. We're looking at risks that deal with finances. And for the currency risk, I have two separate recordings about currency risk. Therefore, I will not discuss currency risk in this session. Let's go ahead and start to explain what interest rate risk is and how to mitigate it. Before we proceed any further, I have a public announcement about my company, farhatlectures.com.
Farhat Accounting Lectures is a supplemental educational tool that's going to help you with your CPA exam preparation as well as your accounting courses. My CPA material is aligned with your CPA review course such as Becker, Roger, Wiley, Gleam, Miles. My accounting courses are aligned with your accounting courses broken down by chapter and topics. My resources consist of lectures, multiple choice questions, true-false questions, as well as exercises. Go ahead, start your free trial today.
What is interest rate risk? It's the potential of losing money as a result of a change in interest rate. So you made an investment, and that investment it loses in value because of changes of interest rate. The interest rate went up or the interest rate went down. As a result, you are losing money. These risks usually affect fixed income securities. We're talking about bonds and loans. Bonds and loans are the same. It means you purchase a bond or you lend money. So what happened is this. Let's assume you purchase a bond and the bond is paying you 8%. That's fine. You're happy with that. Then interest rate overall went up to 10%. What happened to your investment? What happened to your 8%? It will go down in value. Why? Because your investment, if you want to sell it, it's only paying 8%. Other investments are paying 10%. So when interest rate rise, the value of bonds typically falls, since newer issue, which is the 10%, might offer higher yield, making the older one less attractive by comparison. And of course, conversely, the opposite is true. The value of existing bonds increase if the overall interest rate goes down. So if the interest rate goes down to 6% and you have a bond paying 8%, your bond value will go up. Now, how to mitigate interest rate risk? Well, you could use interest rate hedging. Like what? Options and futures. It involves using financial instruments, options and futures. What are options and futures? I'm going to just briefly tell you what they are. It gives you the right to sell or buy something at a specific price down the road, buy or sell. Now, if you have an asset, a bond, and you want to protect it, you may want to buy the right to sell it, either in the form of an option or futures. That's one way to do it, options and futures. And swaps. We can also use swaps to hedge against the risk of interest rate changes. What is a swap? An interest rate swap can allow an investor to exchange, for example, a fixed to variable or a variable to fixed. So if you have a fixed investment and interest rate went up and somebody else has a variable investment and you guys agree to swap, then they have to swap. This way, because interest rate went up, you want to recover your investment. But the opposite is true. If interest rate goes down, they will swap with you. But this is one way to manage if you want to manage your risk, just FYI. Another way is to do what's called bond laddering. What's bond laddering? It involves holding bonds with different maturity date. This is what a ladder would look like, a ladder. And rather than buying bonds that they mature all at once, matures mean you get your money all at once, you want to buy bonds and they mature in series. So every period you'll get some money. And this way you can take this money and invest. Take this money and invest. This way you are not stuck with the full amount, and when you get the full amount, the interest rate might be low. So this way you get the money, some of the money earlier, and you can basically hedge. You could also do what's called adjustable rate instrument. You can buy a bond or a loan, or you can lend money with adjustable rate interest. So if interest rate goes up, you get more money. Why? Because your interest rate is variable, unlike fixed rate instrument. What is market risk? Well, market risk is also known as systematic risk. There's systematic and unsystematic. Market risk is systematic risk, and we'll talk about those in a separate recording. Refer to the potential for an investor to experience losses due to factors that affect the overall performance of the financial market in which the investor is involved. So unlike specific risk, unlike unsystematic risk, which affect individual asset or small groups of asset, market risk has the potential to affect all assets to some degree, especially those that are highly correlated. Now, what is correlated? Correlated means they move in the same direction as the market. For example, if you hold technology stocks, what's going to happen is this. Let's see, tech. If you hold technology stocks, technology stocks always work hand in hand with the NASDAQ. If the NASDAQ goes down, your technology stocks will go down, and the opposite is true. So your technology stocks are correlated with the NASDAQ. Okay, this is what we mean by that. Market risk is generally caused by forces such as economic recessions, which you have no control about, political turmoil, change in interest rate, natural disaster, terrorist attack. It can also be influenced by global event if the investments are international or influenced by international factors. How to mitigate market risk? Well, there's a variety of ways. One of them is diversification. What's diversification? Diversification is holding assets or holding investments that are not correlated. Remember, correlated means they work all in the same direction. Well, you can hold investments. For example, if you have Amazon, if you have Apple, if you have Netflix, they're all technology companies. So what you want to do, you want to have Amazon, you don't want to have Apple. You want to have, for example, another company like Caterpillar. And you want to have a third company that's totally in a different environment, TJ Maxx, okay, which is a retailer. So you want to have stocks in different industries. So that's what they're supposed to be uncorrelated rather than they work in the same direction. You could also use what we discussed earlier, hedging instruments such as options and futures. This way you can sell your investments at a certain price, but you have to pay premium for that. You could also have what's called asset allocation that balance potential return with the acceptable level of risk. So you really don't want to take too risky of an investment, and you could always do a short sale. Short sale means you buy an investment and you will benefit from it when the market goes down. So if your risk is the market going down, this investment will go up and will make the difference. We also have what we call credit risk. Now, credit risk is also known as default risk. So credit risk is also related somehow a little bit to interest rate, but it's not the same. Now you are the lender. When you are the lender, when you're lending money, you have a credit risk because there's always the possibility that the borrower will not pay you the money back or meet their contractual obligation. So when the lender provides a loan, there's a risk that the borrower will not repay the loan or will miss payments. So credit risk apply to debt investments such as bonds and loans and credit derivatives. However, you are the lender in this situation. You are not buying the investment, you are lending the money. It's also concern for financial institutions that issue credit to customers. For example, when you issue credit or when you sell goods on credit, you have an accounts receivable. How to mitigate credit risk? The first thing is, right from the get-go, don't give credit unless those are credit-worthy customers. You do what's called credit analysis. Before you lend the money, before you sell them on credit, you review their credit history, financial statements, tax return, cash flow projection, and any other information that's going to help you. You diversify. You don't lend money to a specific group of companies in a geographical area, specific geographical area or specific industry. Again, you want to have something that's not correlated, customers that are not all correlated, because if they're all correlated and something happens, all your money is gone. You could impose loan covenants, and loan covenants, we have a separate recording for this. Simply put, you put conditions, certain conditions on the borrower to protect yourself, to make sure that they fulfill their conditions. You put conditions on them from refraining from certain activity that could increase credit risk. For example, you might require the company to maintain certain financial ratios, debt coverage ratios, current ratios, and you limit them from borrowing additional money or paying dividend because you want to be paid first. You could also do what's called secured lending. How do you do that? Well, you ask them, you want a collateral in return to providing the money. So if something happened to their creditworthiness and they cannot pay the money, you can seize, you can take the collateral like a building, warehouse, a vehicle, their inventory. Sometimes you could ask as for the receivable as a collateral. Also, you can what called buy credit derivatives, like a default swap, similar to something called default swap. In other words, you buy insurance. If something happened to your loan, basically it's insured. Let's talk about liquidity risk. Liquidity risk refers to the possibility that an individual or a company will not be able to pay their short-term obligation due to the inability to convert quickly assets into cash without significant loss of value. It also applies to the risk of being unable to buy or sell an asset quickly in the market because there is no buyer or seller. And there are two types of liquidity risk. One type of liquidity risk is called asset liquidity risk. You have the asset, you can sell it, but if you sell it, you're going to incur losses. Okay, so occur when a party cannot sell the asset or unwind a position without substantial losses. That could be due to asset-specific issues like unique piece of real estate or broader market condition like stock market crash. A case in point here is Silicon Valley Bank. This is what happened to Silicon Valley Bank. Silicon Valley Bank had many bonds that are long-term, and when interest rates spiked, and we talked about interest rate earlier, when interest rate goes up, your bond goes down. So their bonds go down, that's fine. But what happened to Silicon Valley Bank, all the depositor wanted their money. They have the bonds, they can sell the bonds, but if they sell them, they incur losses. And that's what happened. As they sell more bonds, they incurred more losses. The government had to come in and bail them. Actually, I do have a recording on YouTube about Silicon Valley Bank. If you Google Farhat Silicon Valley Bank collapse, you will find it. Another type of liquidity is funding liquidity. Simply put, here you don't have the money. Here you have the asset, you can sell it, but you're going to incur losses. Here you don't have the money, and you don't have the asset. Occur when a party does not have enough liquid asset to meet its short-term obligation. So the business is not having enough cash. How do you mitigate against this? Well, asset diversification. Well, diversifying asset into various classes, some of which highly liquid and can help liquidity needs. So you don't put your money like Silicon Valley in long-term assets. 2, matching. Matching what? Matching your future, matching cash flow matching. This is basically, it's called cash flow matching. You're going to see it in a moment. So what you do, you align your liquidity, your assets and liabilities at the same time. So if you know you need in the future, you need $1 million, you want to make sure you have an asset of $1 million. Therefore, you have $1 million of assets, liquid asset, $1 million of liabilities. That's why you're matching your cash flow. You want to do credit lines. Always make sure you have another credit line readily available in case you run out of money, so the bank is ready to lend you the money, like a credit card, credit lines. Stress testing on a regular basis. Simulate what would happen if you lost money quickly. Can you recover? 5, cash flow projection, which is the same thing as matching. Regular projection of cash flows can alert a firm of potential liquidity shortage. You always want to match, how much cash you need, how much cash inflow versus outflow, and make sure they match. Let's take a look at a multiple choice question from Farhat Lectures that's going to help us understand these concepts better. Which of the following action would best help Farhat to mitigate potential interest rate risk associated with bond investments? So we have a bond investment. How can we mitigate the interest rate risk? A, investing solely in long-term fixed rate bond. Well, again, you have all your assets in one bucket, and why would long-term protect you from interest rate? If interest rate goes up, your long-term bond will be affected, and this is exactly the case for Silicon Valley. So therefore, the answer is A, is out. Pursuing a bond laddering strategy. What's a bond laddering strategy? Again, it looks like a ladder. What you do is you buy investments, buy in bonds, but they mature on different time. They don't all mature at once. So you get a little bit of money. So if interest rate changes, you can go back and reinvest your money. Would that be a good idea? I would say, sure, why not? This could help. But let's look at C and D. Increasing investment in volatile stock. No, that's exposing more risk to yourself. Converting all holdings to cash. That's great. That's zero risk. But that's not the question here. The question is, you have the investment, how to protect yourself. It's not like, you not having any investments. Therefore, the answer indeed is B. What should you do now? You want to go to Farhat lectures and look at additional MCQs. That's going to help you understand this concept better. If you're studying for your CPA exam, make an investment in yourself. Study hard. Good luck. The CPA exam is worth it. And of course, stay safe.